In today's video, we are doing a deep dive into hospital accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us because this video covers everything. In this section, we dive into the intricacies of hospital accounting. From the business model of healthcare institutions like Apollo hospitals to the unique accounting challenges they face, you'll gain a comprehensive understanding of how this industry operates financially. The hospital industry is a critical sector focused on healthcare services, with a global market size exceeding $7 trillion. Major players like Apollo hospitals in India provide comprehensive healthcare services, including diagnostics, treatment, and rehabilitation. Understanding the industry's scale helps in appreciating the diverse revenue streams and costs associated with hospital operations. Hospitals earn revenue primarily through patient services such as surgeries and consultations. Apollo hospitals also generate income from diagnostics and pharmacy sales. Major costs include staff salaries, medical supplies, and infrastructure maintenance. Understanding these financial dynamics is crucial for managing hospital profitability and sustaining operations. In hospital accounting, departments such as finance, operations, and procurement play critical roles. Finance manages budgets and financial reporting, while operations ensures efficient service delivery. Procurement handles equipment and supply acquisitions. Each department's activities have financial implications, impacting overall hospital efficiency and cost management. Understanding the workflow in a hospital like Apollo involves several key steps, starting from patient admission to discharge and billing. This structured process ensures quality care and accurate financial transactions. Each step in the workflow has accounting implications, such as cost allocations and revenue recognition, critical for financial integrity. Hospitals interact with a variety of stakeholders, including patients, vendors, regulators, and financial institutions. Each has unique accounting implications. For instance, patient billing affects revenue, vendor agreements impact cost management, and regulatory compliance ensures legal financial practices. Understanding these relationships is vital for effective hospital accounting. Hospital accounting faces unique challenges like managing a complex working capital cycle due to delayed insurance payments and regulatory requirements. Hospitals must accurately match revenue with patient care costs. Additionally, regulatory compliance demands precise financial reporting to avoid penalties and maintain trust with stakeholders. Hospital accounting is distinct due to its focus on patient care, compliance with healthcare regulations, and complex cost structures. Unlike generic businesses, hospitals must account for diverse services and unpredictable revenue streams from insurance claims. This complexity requires specialized financial management to ensure accuracy and efficiency in financial reporting. In hospitals, the accounting team, often part of the finance department, is responsible for passing accounting entries. These entries are triggered by financial transactions, such as patient billing and vendor payments. Accurate entry recording is essential for maintaining financial integrity and supporting decision-making based on reliable financial data. In this section, we'll explore the entire hospital accounting process from start to finish. We'll cover every critical step, from requisition and approval to payment and reconciliation. Each stage involves specific departments and documents impacting financial accounts. Understanding these processes is essential for maintaining accurate financial records in a hospital setting like Apollo hospitals, which ensures transparency and efficiency in healthcare operations. The first step involves the identification of needs for medical supplies or services. The hospital's procurement department creates a requisition form detailing what is required. This step ensures that all requests for purchases are documented and justified. The proper documentation prevents unauthorized purchases, which could lead to financial discrepancies. It's crucial that this form is accurate, as errors can lead to over-ordering or undersupplying, impacting patient care and financial balance. Once a requisition form is created, it requires approval from the respective department heads and the finance department. This approval process is crucial for budget control, ensuring that purchases align with financial plans. Approvals help prevent overspending and ensure that funds are allocated properly. Delays or errors in this step can lead to stock shortages or budget overruns, affecting hospital operations and patient care. After approval, the procurement team prepares a contract and issues a purchase order, PO, to the supplier. The PO outlines the terms agreed upon and acts as a legal document for the transaction. This document ensures that both parties are clear on deliverables and pricing. Errors in the PO, such as incorrect quantities or prices, can lead to disputes or supply chain disruptions, harming the hospital's operational efficiency. Once goods or services are delivered, the receiving department confirms their match with the PO. This step involves checking the quality and quantity against what was ordered. The receiving report generated is crucial for verifying deliveries and initiating the payment process. Inaccuracies in this step may lead to inventory errors or payment for incorrect items, impacting financial accuracy and inventory management. Following receipt confirmation, the supplier sends an invoice. The accounts payable department matches this invoice with the PO and receiving report. This three-way matching ensures that the hospital only pays for correctly received items. Errors or mismatches can delay payments and damage supplier relations, affecting future supplies. Accurate matching is vital for maintaining trust and ensuring smooth supply chain operations. Upon successful matching, the finance department initiates payment to the supplier. This step involves issuing checks or electronic transfers. Timely and accurate payments maintain good supplier relationships, essential for ongoing hospital operations. Delayed payments can result in supply disruptions. Ensuring payments are processed correctly requires vigilance against errors like duplicate payments, which can lead to financial loss. Reconciliation involves verifying that all transactions are correctly recorded in the hospital's financial systems. The finance team compares bank statements with internal records to ensure accuracy. This step is crucial for identifying discrepancies, such as missed transactions or unauthorized payments that could affect financial reporting. Regular reconciliation helps maintain accurate financial statements, ensuring compliance and facilitating external audits. The period close involves finalizing all financial activities for a month or quarter. The finance department ensures all transactions are recorded and reconciled. This process includes generating financial statements and reports for management review. Accurate period closing is essential for transparency, enabling informed decision-making and regulatory compliance. Errors in this step can lead to misreported financial health, affecting strategic decisions and external relations. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition is critical in accounting as it dictates when income is recorded in financial statements. For hospitals like Apollo, this is particularly important due to the complex and varied billing cycles involved in patient care and insurance claims. The standard governing this is Indian Accounting Standard 115, similar to International Financial Reporting Standards 15, which emphasizes that revenue should be recognized when control of goods or services is transferred to the customer. In a hospital setting, this could mean recognizing revenue when a patient is discharged, ensuring accurate reflection of services rendered. Unlike general accounting, hospital revenue recognition must account for variable considerations like insurance reimbursements and co-payments. Inventory valuation is the process of assigning a monetary value to a company's inventory, crucial for understanding cost of goods sold and inventory levels. In hospitals where efficient supply management can impact patient care, accurate valuation is essential. Indian Accounting Standard 2 governs this area, similar to International Financial Reporting standards, allowing methods like first in, first out, or weighted average to determine inventory costs. For Apollo hospitals, employing FIFO might mean that the oldest medical supplies are used first, ensuring minimal wastage. Unlike general businesses, hospitals must manage perishable and time-sensitive inventory, making accurate valuation a challenging task linked directly to service quality. Fixed assets and depreciation are key components in accounting for long-term tangible assets like buildings and medical equipment, crucial in hospital settings due to the high costs involved. Indian Accounting Standard 16, following International Financial Reporting Standards guidelines, dictates how these assets should be recorded and depreciated over their useful life. For Apollo hospitals, this means recognizing the gradual wear and tear of an MRI machine, reflecting its consumption and aligning costs with revenues over time. Unlike general accounting, hospitals must often consider rapid technological changes impacting the depreciation schedules for medical equipment. Lease accounting deals with the financial treatment of leased assets, significant for hospitals due to the frequent leasing of buildings, equipment, and technology. Governed by Indian Accounting Standard 116, aligned with International Financial Reporting Standards 16. The focus is on recognizing the right-of-use asset and corresponding lease liability on the balance sheet. For Apollo hospitals, this could involve the leasing of advanced diagnostic machines, where the right-of-use asset represents the economic benefits they expect to derive from the machine. Compared to general accounting, hospitals face unique challenges such as balancing lease terms with technological obsolescence in medical equipment. Provisions and contingencies involve accounting for future liabilities and uncertain events, critical in healthcare due to potential malpractice claims and patient-related legal issues. Indian Accounting Standard 37, consistent with International Financial Reporting Standards, guides the recognition of provisions when an obligation is probable and can be measured reliably. For Apollo hospitals, this may involve setting aside funds for potential patient claims, ensuring financial readiness. Unlike general businesses, hospitals must prepare for unique contingencies like healthcare litigation risks, emphasizing the need for accurate estimates and prudent financial planning. Deferred revenue is a liability representing income received but not yet earned, common in hospitals offering prepaid healthcare plans or advance patient payments. Indian Accounting Standard 115, aligning with International Financial Reporting Standards, mandates that revenue is recognized only when the related services are rendered. For Apollo hospitals, this could mean recording deferred revenue when patients prepay for a surgery scheduled in the future, ensuring that revenue reflects actual service delivery. In contrast to general accounting, hospitals frequently encounter deferred revenue due to advance payments for extensive or ongoing medical treatments. Cost allocation involves distributing overhead costs to various departments within an organization, ensuring each department reflects its true financial performance. In hospitals, accurate cost allocation is vital for managerial decision-making, enabling efficient resource allocation across diverse services like emergency care, surgery, and outpatient clinics. This process ensures departments like radiology or surgery at Apollo hospitals are charged proportionately, reflecting their actual resource use. Compared to general businesses, hospitals face more complex allocation challenges due to the variety of specialized services provided and the need for detailed cost tracking. Segment reporting involves disclosing financial information for different segments within a business, providing stakeholders with a better understanding of performance across various areas. For hospitals, segment reporting under International Financial Reporting Standards 8 helps reveal how different departments like cardiology, oncology, or emergency services contribute to overall performance. Apollo hospitals can use internal management reports to define these segments, providing investors and regulators with detailed insights. Unlike general accounting, hospital segment reporting must align with diverse service lines, requiring precise allocation and analysis of revenues and costs. Financial instruments in accounting refer to contracts that give rise to a financial asset for one entity and a financial liability or equity instrument for another. This is crucial for hospitals managing their financing and investment portfolios. Governed by Indian Accounting Standard 32 and International Financial Reporting Standards 9, this area focuses on the classification and measurement of financial instruments. For Apollo hospitals, this could involve differentiating between long-term loans and short-term investments, ensuring accurate financial reporting and risk management. Unlike general businesses, hospitals need to balance investment in medical advancements with financial stability, making accurate instrument management essential. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. When the owners invest capital, it increases the hospital's equity, reflecting the owner's stake in the business. The debit to the bank account shows the increase in actual cash available for use, while crediting equity indicates the increase in owner's investment. This foundational step is crucial for acquiring assets and funding operations, setting the stage for future transactions. Purchasing equipment like an MRI machine is a capital expenditure necessary for hospital operations. By debiting the medical equipment account, we increase the hospital's fixed assets. The corresponding credit to the bank reflects the cash outflow. This transaction highlights the importance of aligning capital expenditures with operational needs, ensuring the hospital is equipped to deliver high-quality care. Purchasing supplies on credit allows the hospital to maintain liquidity while ensuring necessary stock levels. Debiting the inventory account records the acquisition of current assets, while crediting accounts payable creates a liability to suppliers. This approach helps manage cash resources effectively, balancing operational needs with financial obligations, and highlights the importance of working capital management in healthcare. Paying salaries is a routine operational expense, essential for maintaining staff morale and operational efficiency. Debiting the salaries and wages expense account reflects the cost incurred in running the hospital, while crediting the bank shows the cash outflow. This transaction underscores the hospital's commitment to compensating its workforce, which is integral to delivering effective healthcare services. Revenue recognition aligns with the accrual accounting principle, recording income when earned, not necessarily when received. Debiting accounts receivable indicates the hospital's claim on cash from patients, while crediting revenue from services recognizes the income. This practice is vital for accurately portraying the hospital's profitability and cash flow expectations, providing insights into its financial health and service capacity. Receiving payments from patients translates receivables into cash, vital for operational sustainability. The debit to the bank reflects increased cash reserves, while the credit to accounts receivable decreases outstanding claims. This transaction ensures the hospital has the necessary funds to meet immediate financial obligations and invest in future growth, illustrating the importance of efficient cash management in healthcare operations. Timely payments to suppliers maintain healthy relationships and secure future credit terms. Debiting accounts payable decreases liabilities, while the credit to the bank shows cash outflow. Efficient supplier payment practices are essential for consistent supply chain management, ensuring the hospital can continue providing quality care without disruption due to supply shortages or credit issues. Depreciation allocates the cost of tangible assets over their useful lives, matching expense with revenue generation periods. By debiting depreciation expense, the hospital acknowledges the asset's consumption. Crediting accumulated depreciation reduces the asset book value without affecting cash. This practice ensures accurate financial statements, providing a more realistic view of asset value and profitability over time. Interest payments are ongoing financial obligations resulting from borrowing funds. Debiting interest expense reflects the cost incurred, while the credit to the bank indicates the cash outflow. This transaction is vital for maintaining good credit relations and ensuring future borrowing capabilities, which are essential for capital-intensive industries like healthcare, supporting both operational and strategic financial planning. Year-end closing consolidates financial activity, moving temporary accounts to income summary to determine net income. Closing revenue and expense accounts balances helps reset for the new period. Ensuring accuracy in these entries is critical for reliable financial reporting, guiding strategic decisions, and providing stakeholders with a clear picture of financial health, crucial for long-term sustainability in the healthcare sector. In this section, we will go through all the key concepts of financial statement impact in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In hospital accounting, current assets like cash and accounts receivable are crucial for liquidity. When Apollo Hospitals increases its cash, it enhances its ability to meet short-term obligations. Conversely, accounts payable and accrued expenses are liabilities that indicate amounts owed. Managing these effectively ensures a hospital can sustain operations and invest in growth, impacting financial stability and creditworthiness. Non-current assets like property and equipment are vital for Apollo Hospitals as they represent long-term investments essential for service delivery. When these assets increase, it signifies capacity expansion. On the equity side, higher share capital and retained earnings reflect a robust financial position, enabling the hospital to fund operations and future projects without excessive reliance on debt. In the profit and loss statement of Apollo Hospitals, patient revenue is a primary income source. Increasing revenue boosts profitability and operational expansion. Direct costs like medical supplies and personnel are necessary expenses. Their efficient management is vital to maintain gross profit margins. Balancing revenue with these costs ensures the hospital can sustain high-quality service delivery while remaining financially viable. Apollo Hospital's gross profit reflects revenue minus direct costs and is a key indicator of operational efficiency. EBITDA, or earnings before interest, taxes, depreciation, and amortization, further refines this by excluding non-cash expenses, providing a clear view of cash flow potential. Managing operating expenses and depreciation is crucial, as these directly impact profitability and the ability to reinvest in hospital infrastructure and services. For Apollo Hospitals, cash flow from operating activities is crucial for day-to-day operations. Positive cash flow here ensures liquidity for immediate needs. Investing activities often result in cash outflows due to asset purchases, indicating growth. Financing activities, such as loans or equity issuance, provide cash inflows to support expansion. Balancing these cash flows ensures the hospital can maintain service quality and invest in future capabilities. Key financial ratios provide insight into Apollo Hospital's performance. The current ratio assesses liquidity, crucial for covering short-term obligations. A lower debt-to-equity ratio enhances financial stability, indicating manageable debt levels. An increased gross margin signifies operational efficiency, while a higher return on assets (ROA) reflects effective asset utilization, contributing to profitability. Monitoring these ratios helps in strategic decision-making and maintaining financial health. In this section, we will go through all the key concepts of common errors in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In hospital accounting, incorrect handling of audit findings can arise from a misunderstanding of healthcare regulations. For instance, Apollo hospitals might misclassify revenue due to an oversight in contractual agreements. This affects the financial statements by potentially overstating income, leading to misinformed decisions by management and stakeholders. Auditors detect these issues by thoroughly reviewing contracts and comparing them with recorded transactions to ensure compliance and accuracy. In the context of Apollo hospitals, interview traps in hiring accounting staff can lead to employing individuals who lack necessary skills. When candidates exaggerate their experience with hospital-specific accounting software, it can result in financial inaccuracies and compliance issues. These errors manifest through inconsistent financial reporting and missed regulatory deadlines. To avoid this, implement thorough interview processes, including practical assessments to verify candidates' expertise, ensuring only qualified individuals handle sensitive financial data. In hospital accounting, ERP system mistakes frequently occur due to incorrect data entry or system misconfigurations. For Apollo hospitals, these errors could lead to misreporting of patient billing or inventory levels, affecting financial statements. Such inaccuracies can distort cost analyses and budget forecasts. These mistakes often happen when users lack training or when systems aren't customized to healthcare specifics. Regular audits and comprehensive training programs can help prevent these issues, maintaining data integrity and financial accuracy. Cutoff errors in hospital accounting, like those at Apollo hospitals, occur when revenue transactions are recorded in the wrong accounting period. For instance, recording patient services provided in January as December revenue can inflate financial performance for the prior year. These errors mislead stakeholders about the hospital's true financial status. Thorough review of transaction dates and adherence to revenue recognition principles are necessary to ensure accurate period reporting. Auditors examine transaction timing to detect such discrepancies. Standard switching errors in hospital accounting occur when there is inconsistency in applying accounting standards, such as switching between international financial reporting standards and local generally accepted accounting principles without proper justification. At Apollo hospitals, this can lead to unreliable financial reporting, affecting comparability and stakeholder trust. These errors might occur during periods of regulatory change, or when new staff are unfamiliar with the hospital's standardized practices. Ensuring consistent application through regular training and updating accounting policies helps maintain accurate, reliable financial statements. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In cash accounting, revenue and expenses are recorded when cash is actually received or paid. Accrual accounting, however, records revenues and expenses when they are earned or incurred, regardless of cash flow. Apollo hospitals might use accrual accounting to match income and expenses to the period they occur, offering a more accurate financial picture. For example, services rendered in December but paid in January would be recorded in December under accrual accounting. Indian Accounting Standard 115 addresses the timing and amount of revenue recognition from contracts with customers. In healthcare, it ensures that revenue from services is recognized when the performance obligations are satisfied. For Apollo hospitals, this means recognizing revenue when the healthcare service is provided, ensuring accurate financial reporting. For instance, if a surgery spans 2 fiscal periods, revenue must be recognized as the service progresses, not just when payment is received. Hospital ERP systems integrate various functions like patient billing, inventory management, and financial reporting into a single platform. This integration helps Apollo hospitals streamline operations, reducing manual errors and duplication. Features like real-time financial analytics allow for better decision-making and resource allocation. For example, inventory management within ERP can automate stock reordering, ensuring supplies are available when needed, thus enhancing operational efficiency. When Apollo hospitals provide services on credit, the journal entry is to debit accounts receivable and credit service revenue. This reflects the earned revenue and the receivable yet to be collected. For example, if a patient receives a $10,000 surgery on credit, Apollo hospitals would debit accounts receivable for $10,000 and credit service revenue for $10,000, recognizing the revenue earned and the amount due from the patient. International Financial Reporting Standard 16 requires lessees to recognize almost all leases on the balance sheet, reflecting a more accurate financial position. For Apollo hospitals, this means lease agreements, such as for medical equipment, are recorded as assets and liabilities. This change improves transparency, but also affects financial ratios and debt covenants. For instance, recognizing a hospital building lease increases both assets and liabilities, offering a clearer view of the hospital's financial commitments. Cost allocation in hospitals like Apollo involves distributing indirect costs across various departments, which can be complex. Challenges include accurately tracking shared resources and services, such as utilities or administrative support, which don't directly generate revenue. Misallocation could skew financial analysis and decision-making. For instance, the costs of hospital maintenance must be fairly distributed to avoid overstating or understating a department's financial performance. Internal controls in hospitals like Apollo are essential for safeguarding assets, ensuring accurate financial reporting, and promoting operational efficiency. They help prevent fraud and errors by establishing checks and balances, such as separating billing from collections. For instance, having different personnel handle patient billing and payment collection minimizes the risk of misappropriation and ensures that financial statements reflect true financial health, fostering trust among stakeholders. Charity care, provided by hospitals like Apollo, is not recognized as revenue or bad debt. Instead, it's treated as a deduction from revenue in the financial statements, reflecting services provided without expectation of payment. Proper documentation is critical to ensure accurate reporting. For example, if $100,000 in services qualify as charity care, Apollo would reduce gross patient revenue by this amount, providing a clearer view of revenue actually expected to be received. Unearned revenue arises when payment is received before services are rendered. In hospital accounting, such as at Apollo, it is initially recorded as a liability. As services are provided, the revenue is earned and moved from liability to income. For instance, if a patient prepays $5,000 for future treatments, the Apollo records it as unearned revenue, gradually recognizing it as income when treatments occur. Donated medical supplies are accounted as both an asset and contribution revenue. Apollo hospitals would record the fair value of the supplies, reflecting their role in financial resources. This enhances transparency and aids in assessing financial health and support from the community. For example, if supplies worth $20,000 are donated, Apollo would debit the supplies inventory and credit contribution revenue, indicating resources received without cash outflow. Apollo Hospitals operates with multiple revenue streams, including patient services and pharmaceutical sales. An understanding of the patient process is essential, from registration to discharge, ensuring billing accuracy. Insurance claim management is crucial, requiring pre-authorization and post-treatment submissions. Supply chain efficiency and cost control help manage operational expenses effectively. Compliance with health regulations and adopting EMR technology enhance both regulatory adherence and data management. In hospital accounting, revenue is recognized upon service delivery, even if payment is deferred, ensuring accurate income reporting. Expenses align with revenues, recorded as they occur. Prepaid services become deferred revenues until they are fulfilled. Asset management involves capitalizing equipment and depreciating over its useful life. Tracking accounts receivable from insurance and patients is crucial for cash flow. Key journal entries include patient billing and supply purchases, while inventory is valued using methods like FIFO. Interview preparation for hospital accounting rules involves understanding revenue recognition tied to service delivery, despite deferred payments. Familiarity with healthcare regulations is crucial to comprehend their impact on financial reporting. You should be adept at interpreting financial statements and discussing cost management strategies. Explain EMR systems' role in billing accuracy and data management. Discuss insurance processes from pre-authorization to claims. Showcase problem-solving abilities in addressing healthcare-specific accounting challenges. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to CandiMentor for more finance and accounting videos. We will see you in the next one.